Dear friends, thank you for supporting this channel on Patreon to join our growing family of donors, now 59 patrons strong. And remember, once we reach 100 active patrons, we will start sending out a 1-ounce U.S. Silver Eagle, autographed by your host, Dunnigan Kaiser, to one active supporter each and every month. Thanks for taking a minute to pitch in by going to patreon.com/reluctantpreppers and pledging your support today. Thanks very much.
Hey Reluctant Preppers, this is showing you just how easy it is to purchase silver without paying any premium over spot price. You just go to sdbullion.com/RP, scroll down and enter the special code to get silver without any premium, and they'll mail it to your mailbox, discreetly packaged. Inside you'll find a beautiful 10-ounce bar of fine silver, and you are able to purchase that and have it and add it to your stack and your collection without paying any premium, and you're supporting Reluctant Preppers along the way. Thanks.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Okay, let's get back to the crash of 2008.
Please.
And it was called, in the year or two afterward, it was called financial terrorism by a financial firm, not a well-known one, a small one, that, of all things, was contracted by the Department of Defense to investigate what went on in that 2008 debacle. And that small firm, I forget the name of the gentleman who owned it and ran it, but he did the study, and I believe his number showed $13 trillion in capital was sucked out of the capital market of the U.S. by operators. And so in that circumstance, I need to back up a little bit from 2008 and tell you how they prepared to get into it and to do it. There were a number of things to be put into place for this orchestration. There had been as we well know at this point, because it was blamed for the situation, but there was a law passed. I was going to talk about mortgage-backed securities, but before that, in 1999, Congress decided that it was going to permit the design and development and sale and trade and so forth of so-called financial derivatives on an unregulated basis. And that began to bloom in the early 2000s. And of course, one of the results of it was that oil futures company that went bust in a big way. And maybe I'll think of it in a minute. But you'll remember that Arthur Andersen was basically destroyed as a company, as the big accounting firm.
Enron?
Yes, Enron. Because Enron supposedly was engaging in some kind of fraud, and somehow or other Arthur Andersen, which in my working career, Arthur Andersen was regarded as the top major accounting firm. And yet, they put them under for supposedly this not identifying and publicizing this fraud in Exxon. But nevertheless, it was basically these financial derivatives were being sold relating to oil. Well, there were other financial derivatives being designed as well. And one of them related to mortgages. Mortgages had become a way of putting securities together, designed securities that would be attractive to financial firms that were looking for certain types of return on investment. And so you could design a mortgage-backed security in such a way as to appeal to a certain niche and a certain niche and a certain niche by just giving them different qualities, and you split up the kinds of things that certain parties want and other parties don't want, but they'll take these other. So they developed quite a business in mortgage-backed securities with designs that would provide high-quality credit with certain types of return on investment that would satisfy the needs of sometimes government, sometimes private organizations. And so that got to be very active. And of course, there was the so-called housing boom and mortgage lending and so forth during the early 2000s that came later to be blamed for the 2008 crash. And supposedly, what was blamed also is that housing buildup and the additional mortgages would never have been done if the Fed hadn't been so profligate in increasing the money supply. They just increased it out of hand, supposedly. The problem is, if you look back at the facts, they actually didn't increase it out of hand. If you look at the years from 2000 all the way through 2007, 2008, the largest amount of new funds added to the monetary base in any one year was $45 billion. And that was in 1 year after the Bush tax cuts had taken effect, and we had quite a growing economy. And so $45 billion in the size of the overall monetary base was really not at all out of pace with the growth in the economy and what would have been needed in order to avoid deflation again. As a matter of fact, it took quite a while during those Bush years for the gold price, for example, to even recover from the deflationary lows down. It got down to something like $252 an ounce in 2000. I think I may have mentioned already that in 98 or so, I think oil $10 a barrel. Mm-hmm. Well, in 2000, we were still well below $300 an ounce. And again, 325 was regarded by Jude Winniski as, sort of, that's the number we need to get out of this deflation that we were in the entire time of the tech crash. And yet we were just barely climbing the hill just a little bit on the price of gold, getting up toward $300 an ounce it was 2000. Well, I'm a little rusty. I haven't looked in some time, but 2005, something like that. And finally, we got over 300, and we got to finally 325, and 350s, 375, and it was only then that we were really getting out of the deflation that was the absolute necessity that had put us into that tech crash. And so there was not an overabundance of money at all to cause that mortgage boom, but the demand for mortgages in the derivatives business was very high. And so lots of people were making loans, and they were syndicating and making lots of money by selling them into this mortgage securities industry. Well, okay, so we have that circumstance, and we get to the situation of what else was put into place. Well, there was a derivative very important that it was a credit default swap on mortgages and on mortgage securities. Credit default swaps in the past had been used as a kind of insurance policy for bondholders. whether it was corporate or government. You could buy a credit default swap and sort of as an insurance policy to protect yourself in case interest rates went up and you were subject to loss on principal. A credit default swap would protect you on that. It was sort of insurance. But it was always only available to the party who owns the debt instrument. In other words, if you own the bond, you can buy a credit default swap on it and protect yourself. But very importantly, what Wall Street developed was a new type of credit default swap that allows you to buy it on somebody else's bond. It's very much like buying a fire insurance policy on somebody else's house.
Huh.
All of a sudden, you've got a real financial interest in seeing that that house catches fire. That's not a good thing in terms of sound economic policy, obviously. But all of a sudden, we had this ability to drastically affect the market price of bonds and of mortgage-backed securities with these credit default swaps. And so what happens right along at that same time as that credit default swap comes out? Morgan Stanley, I believe it was, and also Goldman Sachs were the major players. This is about the time of Enron. Enron got put out of business, and those two players went together and created another futures market for oil and basically took that business over. But apart from that oil business, let's talk about the mortgages. Morgan Stanley and Goldman Sachs were principal investors, along with others, in starting a little firm over in London, not in the United States, outside the U.S. They started a little firm that set up an index to supposedly measure the volatility and the price movements of the mortgage bond securities. They called it the Abx Fund. And this had a very strange design. It had only a very few mortgage-backed securities in it. And the index identified the bonds that were in it. Now, they had 24 bonds. You could identify which bonds they are. They opened this Abx Index. As I recall, it was in the spring of 2007, something like March or April, thereabouts. And lo and behold, as soon as they put that index into effect, it started dropping like a rock. Now, there was another thing that came into play that's just right at the same time, remarkably, wouldn't you say? There was a new accounting rule adopted by the AICPA, Financial Accounting Standard Boards or something of the sort. I can't call the number of the rule back right at this time. It's in my book. But it turns out to be it was essentially a rule that says mark-to-market accounting. Anyone who owns these mortgage-backed securities have to mark them to market quarterly. And mark them to market, you also run them through your profit and loss statement for the firm.
Okay.
And so it's a drastic effect on your current income. Now, so you have, it was a requirement, in effect, that your auditors see that you do this. And what would the auditors look to as an indication of what your mortgage-backed securities might be worth? Why, they might look to an index, wouldn't they? Well, so that rule came into effect also early 2007. Guess when the last time it was that rule was in effect? in the United States. 1938. It was finally repealed after being in effect during the Great Depression, and finally the financial authorities at that time were persuaded that it was so detrimental to the operation of firms that they had repealed it. And so what we had was those two things put together, the Abx Index and the auditing requirement that you must mark your mortgage-backed securities to market, and the auditors enforce that by looking at, well, what would be an indication of what your mortgage-backed securities are worth. You haven't sold them, that's right.
Right.
But what are they worth? They looked at that index, and the index started falling like a rock, as I said before. Well, why would they do that? Why would the Abx Index be falling so much? Well, in my humble opinion, it was because you could identify the bonds, and all you had to do in order to make those mortgage-backed securities fall is buy a credit default swap on them. Because the function, the financial transactions that take place when you are doing a credit default swap is that you sell short those securities in order to hedge the risk that you take when the seller of that credit default swap sells it to you. And so when you buy a credit default swap on a certain mortgage-backed security, which just happens to be in the Abx Index market, it's going to mean that security is going down, and that will lead that Abx Index to fall. Well, that's exactly what happened the entire length of time that Abx Index was in operation. It fell like a rock, and every quarter, anyone owning those mortgage-backed securities would have to write them down severely, and they had to run millions of losses through their profit and loss statement. Therefore, their stock price got in trouble, and this began to amount the problems of the so-called mortgage crash that was really simply finagling of those pursuant to that design. Here's the design that we can make these things look like they're awful. And guess what? After all was said and done, and all the crashing that took place because of mortgages, the Wall Street financiers who made the most money in the 5 years after 2008 were the ones who bought those mortgage-backed securities at those rock-bottom nickel-to-the-dollar type prices of 2008, 2009, and rode them back up because the mortgage-backed securities weren't worthless at all. Here's another part of the story that I need to tell. One of the hints that I got during that period of time, at the time, that is also discussed in more detail in my book, but there was a very perceptive article by the financial writer Michael Lewis. I'm sure your listeners' audience will recognize that name. He's written a number of very informative books, but he does depend upon, I think, insiders to tell him things. One of the things, though, that he wrote, not in a book, but in a periodical magazine, online internet type magazine, was he said that he was talking with a Wall Street, I think, trader type guy, who was, I believe he's in the mortgage-backed securities end of things, and he was telling Lewis that he was very frustrated that they had a plan to make a lot of money, but they had a problem. They just couldn't find enough, I'll clean up the language he used, rotten mortgages to make it really work. And so that was his dilemma, and he was just chewing nails to try to find up with some idea as to how to get around it. Lo and behold, not long after that, Lewis sees the same guy, and he says, "We found the way." In other words, to have as many rotten securities, mortgage-backed securities, as they want. And it was as simple as recognizing that when you have a credit default swap on a mortgage-backed security, it amounts simply to it's more or less equivalent of a mirror image of the security itself. And so what you have to do is just make your derivative, make a lot of derivatives mirror a particular mortgage-backed security that you know is rotten. That way you can make 1,000 of them with just doing it with credit default swaps mirroring 1,000 times.
Okay.
That's what he did. That's what was done. That's the way they made it crash. And there was another very major aspect of, that basically brought down the mortgage companies in 2070s, the home mortgage companies. The Fed also played another role in that because, just even I told you, they did not expand the money supply at all out of the ordinary up through 2007. And yet they actually started cutting back on it and raised interest rates sufficient for their estimation to put 1 million people out of work. They follow the so-called Phillips curve theory of economics, which is complete garbage. But in very simple terms, it means that people can't buy as much when they don't have a job. Now, that takes a genius because they don't have any money. And therefore, with fewer people chasing the goods that are available for sale, prices won't rise as much. So we fight inflation that way. It is the most outrageous approach toward economic theory and acting like you're doing something good for the people when you're doing the absolute opposite that I can imagine. But that is still what passes for Keynesian economic theory to this day and in this Federal Reserve that we have at this moment. So that is what happened to get the mortgage crisis started. The Fed put, I may be overstating it. It may have been 600,000 that they initially put out of work, jobs lost. When those 600,000 or 1 million, whichever it was, are put out of work, and it's done right now, those people can't pay their mortgages. And yet those are the same people, because they were put out of a job on purpose by the Federal Reserve and those colluding with them on Wall Street, they can't pay their mortgages, and they get to use headlines that, oh my Lord, look at all these people defaulting on their loans, these mortgage-backed securities, especially the ones that were so-called AAA rated. That they're not AAA mortgages at all. These people are just deadbeats. Well, there's a reason for those mortgage-backed securities to be designed to be AAA. The way you get to AAA when you're having mortgage-backed securities is that you put an extra amount of mortgages in there that even if they default to the maximum of the norm in the past, you have an extra amount of mortgages in the kitty
cushion
to pay off the guaranteed return of AAA before they become short. That's the way they get those kind of ratings. But no, the papers didn't discuss any of that thing. It was all a matter of these things are all going to come down around your ears. So everybody was running for the exits. And then, of course, one of the very major things that was a part of the 2008 crash was, again, naked short selling. That is the counterfeiting of shares and the selling of them. By that time, like I said, the uptick rule was no longer even in existence. And you had the computer trading and so forth, but they could naked short sell and not deliver the shares. And the SEC was even openly saying that was okay. In other words, it's not important that you actually deliver those shares that you're selling. even though you're doubling or tripling or more the number of total shares outstanding in that company, and therefore diluting the number of hands holding it, and therefore diluting the share price and making it go down, making it appear to crash among the honest owners that bought it in the first place. That is exactly what happened to Bear Stearns. Bear Stearns was heavily naked short sold in that kind of environment, making its share price drop from 60 to 30. This was all within a week. And then a part of what finished them off with the share price going to zero and the naked short selling making sure that happened. It was easy for Goldman Sachs and J.P. Morgan Chase, for example, to justify to the market that, we don't think we are in a position to pay those amounts that we owe Bear Stearns, and we can't cover this exposure and so forth and so on. And all of a sudden, Bear Stearns is out of business. And bought, it winds up being for $2 a share by guess who? J.P. Morgan Chase. They also did the same thing later that year, 2008, to Washington Mutual, one of the really major mortgage lenders in the banking lenders. I think they had something like 15. I could be mixing, but Washington Mutual was a very substantial company. It again was shut down and taken over by J.P. Morgan Chase. I think with Bear Stearns, I counted something like between $50 and $60 billion that the Fed used to sweeten the deal with to make it doable for Chase to be willing to take them over. Now, in that kind of circumstance, when everyone else was absolutely getting their throat cut in that market, guess how the year was for J.P. Morgan Chase? They reported in their annual report for 2008 that, lo and behold, it was the best year in their history. Lehman Brothers was pretty much the same story. Very heavily naked short selling and having their cash due to them from the other big players on Wall Street withheld from them so that they couldn't meet their cash needs on the daily basis, and they go under. There was, I've got to just mention another thing that is so outrageous because it comes so close to home. But in 2008, two of the very big disasters that occurred that year financially were the so-called mom and pop safest investment you can have, grandmas and retired school teachers and so forth, Fannie Mae and Freddie Mac, the big insurers of the mortgage industry. And what was it that made them go down when I think it was even one of the major financial guys from Goldman Sachs was saying they were still solid financially, but nevertheless, here's what happened in a real nutshell. During that summer, in the August to September timeframe, July, August, Fannie Mae and Freddie Mac, separate big major mortgage companies, insurers, their volume of trade, even though they were held primarily by mutual funds, which ordinarily are long-term holders. They don't, for example, the American group of mutual funds that's managed by Capital Group was the largest shareholder in each of those entities.
Right.
And in that circumstance, they were trading over 400 million shares per day. Trading over 400 million shares per day in July. And in that circumstance, whether it was from maybe someplace in Congress was looking to get some protection for them. For whatever reason, the SEC actually acted and issued an emergency order. They said, there shall be no naked short selling permitted in these named companies. Two of them were Fannie and Freddie. The other were the primary dealers in U.S. Treasury securities in this country and internationally. Which of course tacitly means every other company is fair game, but you can't naked short sell in Fannie and Freddie. And this emergency order is effective for the next 30 days. And everybody knew that the rule was that they can have one extension of that emergency order for another 30 days, and that's it. They can't go more than 60 days. And so guess what? The 400 plus million per day, 450 million trades a day during those 60 days fell to something on the order of 20 million shares per day on Fannie and on Freddie. And the share price, guess what, crept back up. It looked like they were going to make it. And then, of course, the order expires, and immediately we start getting high volume again, and it drops to the floor again. And as soon as it does that, Hank Paulson from Treasury and his confiscators rush in, and in his own description supposedly given to some confidant, said that, I guess the report was that he told President Bush that they were going to take over these two companies, that the first thing the executives at Fannie and Freddie hear will be their heads hitting the floor when we get in there on a Friday afternoon. That's apparently what happened. Both of them were taken over, both put into receivership, and it has been a disaster for the shareholders ever since. They basically commandeered the assets for the government and siphoned off billions in the earnings of those companies in order to pay for, as I recall, pet projects of the Obama administration over the ensuing 8 years after 2008. So that is the sum and substance of how that came down, and it was just as much engineered. Had full cooperation of the so-called law enforcement people. The Federal Reserve was in on the planning relating to Lehman Brothers, relating to Bear Stearns, relating to Fannie and Freddie and so forth, and certainly Paulson was helping to engineer. About the time my book came out, just before I kind of held it up for the presses, I learned from a contemporary magazine story in 2011. I forget the name of the magazine reporting it, but they said that on the day that emergency order of the SEC prohibiting naked short selling of Fannie and Freddie, on the day that it was announced and went into effect, that the Secretary of the Treasury was in a closed-door meeting secretly on Wall Street at one of the major hedge funds, telling those assembled, don't worry a thing about this emergency order. It just can go 60 days. I would interpret that as meaning to keep your ground. This thing is going to zero. And so the naked shorts held their positions, renewed the attack, and the rest is history.